Welcome back, YouTubers, to the Independent Investor, Part 2. The weekend updates. So I mentioned copper there. We can see it did drop a little bit there last week, but the trend is still up. Capstone Mining, CS on the Toronto Exchange, they reported earnings last week that quite didn't meet market expectations, and then with the copper price coming down, we saw a bit of a correction on that stock, and it dropped a little bit out of my channel, but I'm going to just leave it for now and not take any action on it. I'm still profitable on it. If it continues to drop next week, I might close out a portion and lock in some profits. So also my shorts, as I've said, I felt this market's getting expensive, and I kind of just want to be in the market, a bit like a sine wave. When the market's cheap, you apply certain techniques. As the market comes up, you apply other techniques, and that way you're kind of staying in the market. If you get right out of the market during a correction, it is sometimes hard knowing when to get back in. And so, as I said, I did open the short positions, meaning that I want the share price to go down. And of course, last week on Wednesday it wasn't too bad, but then Friday gave me a bit of a scare as I saw the NASDAQ up 2.2% in one day. And but most of that move seemed to be with the fangs, because a lot of my short positions didn't move nowhere near to the same extent. So, and I'm still seeing some of the ones that I had mentioned before continue to kind of break down. And all my short positions I made into an index with E-signal, and I divide that by the S&P 500 to see how they're performing. And actually, they have been performing a little bit about the same or less than the overall market. And these ones, of course, were, because they got so high, were outperforming. So there might be a shift slowly out of them. And you can see that, as I mentioned before, on Domino's Pizza, we really got this very almost textbook shoulder, head, shoulder pattern forming. But we still need it to be confirmed by breaking down through the neckline at 180. So I'll have to see how that develops. And I did do one long put all the way down at 150, which I'll explain later. I typically don't like doing that. But if this does break down, this is relatively cheap and out of the money, relatively low volatility, then this is a bit of a gamble that could increase quite a bit. Again, just one contract, because it is typically higher risk, and I don't typically like doing options for gains. I like doing them more for income. But my bear call spreads up above here looking fairly safe right now, and that goes the same for actually the other PZZA, which is Papa John's. This has actually started to work for me now fairly nicely. Again, we had the shoulder, head, shoulder. We did have kind of, it did rally back up, kind of violated that pattern, but we've clearly broken down now, and quite below my average price. We've gone from a high of 90 down to 68, and if we use the measuring tool on that for a head and shoulders pattern, you can see we're getting down to, we're at 68, and if, as I explained in other videos, you could 62, and I expect it might go below that. And all my bear call spreads on top here now look pretty safe, because they're all up in the 90, 95 range. So I've created some income above as this has slowly drifted down. And I did increase my short position a bit more here. My average price is up around 70, 75. So I'll see how that plays out, but it looks like its technicals it probably could continue down. The only one that hasn't kind of worked out of those three is Jack in the Box, J-A-C-K. And again, it had that shoulder, head, shoulder pattern, but then we've rallied right back up through the neckline and really violated this pattern now. So, and it's coming close to one of my bear call spreads. So again, this is all probabilities and difficult. You never really know. You're just trying to really get it right more than 50%, and then when you get it wrong, you want to get out and limit your losses as much as possible. And that's kind of the way most traders do it. They don't really have big wins per se. It's just more grinding out small, your gains, letting your winners run, and really limiting your losses. So again, I did something similar. I bought an $85 long put right out till June, just in case this does break down again, because I think the valuations are extreme. So I go up pretty long on those as far as I can to give them time to work, right? Because like I said, the market is expensive, but we really have no idea of when a correction is going to come in the near term. I think over the next year or so, I'd be surprised if there isn't at least a 10-15% correction. But the market right now technically just still seems to want to go up. I also opened up one more short, which I did earlier in the year. Again, this has to me very high valuations, and that's Pool Corporation, P-O-O-L. This one I was fairly fortunate to short up at the 120, and I covered down in here as it bounced back up around 100. It's gone right back up and looks like it might be rolling, so that could be a double top. That hasn't played out yet, but so I reopened a short position on that, hoping we get a similar correction back down. I'll have to see again how that plays out. Again, I did a long put on that. It's just a bit of a gamble at 100 for $2, which and that goes out till April, so that does give me a bit of time. So that's on the short side of things. And also, as I said, the market valuations starting to scare me quite a bit, and a lot of other people. And so I'm starting to build my cash position up again. I'm probably, like I say, I'm not reinvesting any dividends now. I just leave them in cash. And I think my cash position now is back up to about 25%. And I think I'm just going to continue to do that. Even some of the companies, even some of my dividend players now, if they have a strong run for whatever reason, I might start liquidating some of those and slowly get out of this, build a position. I mean, cash is an asset group, so it is where you really want to be when a correction does happen. And I think this market could turn quickly. In 1987, we had a large correction because of options kind of being brought into the market. Over this, we've had high frequency trading really come in over the last couple of years, where I think over half the volume now is done by high frequency trading, which is all algorithms and basically trades put in by computers without that much human intervention. And we don't know if the market really turns, how all that's going to play out. We've had some flash crashes in the past where the market's just dropped 100 some odd points, and I don't know how it will play out if we get a real big turn in the market sentiment. So I think at this venture, it's I'm more comfortable being in cash, and as I've said, I continue what's in the market. I continue to move that more to dividend and low beta positions. So that's and actually last week, I've been in this game for quite a while. Every now and then you come across a term you haven't heard of, and this was called Skew, and it's to do with your option volatility. And I'll show a chart here, and it's another bit of a warning that things maybe aren't quite so good under the surface. And what this kind of is, and I got to look into it further, and I might not be giving 100% correct answer here, but basically your options are kind of priced on a somewhat normal distribution curve. So you have one standard deviation will capture 68% of a move in any given day, and then 2% you're at 95, and then at 3 deviations you're less than 1% that would happen on a normal distribution curve. So you always hear this term now, fat tails, and and there's been, I forget the author's name, but he wrote kind of a whole book on this, but we've had some fairly bad crashes now, 2008, 2000 we had the dot-com. So what they're really saying is the fat tail means that this is maybe not that accurate, in that the probability of these events happening is probably higher. That's kind of summing that up, and that means some of the options in that are maybe mispriced. Some equities are mispriced a little bit, not taking that risk into account. And Skew kind of measures this, and it measures it by looking at what people are paying, just like I did on those 2 options. I said buying an option that's way out of money that would have a very, very low probability of happening. But people are starting to buy those, so people may be expecting a higher volatility in some of these stocks. And that's what this measures here. Unfortunately, the data doesn't go back that far, but over crashes it typically has moved up and down. And each signal only goes back to 2011. But we can see after 2011 was just kind of when the recovery was getting going,